What is up, YouTube? This is the Working Investor. In this video, we're going to talk about a fund called Tspy. And the reason why I like this fund and what catches me is because this fund, so far since inception, has outperformed in total returns both the index of the SPX, which is the S&P 500, and has outperformed other funds out there that are income-based funds. So this is why I like this fund so far. I'm keeping my eye on it. And I want to explain to you what this fund does. I've been going through the website and I've been watching multiple videos of the fund manager, and he goes through a lot of details. You can go in, and I'll put you some links of some really good videos where you can hear from the mouth of the fund manager himself how the fund works. And let me show you right now why I have the appeal to the fund. So let's just look right now at total returns, right? So let's look at XPX. SPX is the index that it uses. It actually buys the underlying index. It doesn't do synthetics. So that's something unique. It actually buys it. It tries to actually hold the index, and it also does cover calls against it. They do 0 day to expiration cover calls, so you get crazy amount of theta decay, but they don't do overnight exposure. So that's something where it's a little bit different from the Roundhill Xdte, where they do have overnight exposure gap ups in the market. But let's look at total return. So the fund opened up August 15th, 2024. So it's been around for approximately 80 days, calendar days so far, at the time of this video, which is November 3rd, 2024. So I basically compared total returns for everything I'm going to talk about right now, starting from exactly August 15th till today. The SPX, we'll use this as the benchmark. The total return is 3.17%. 3.17%. Let's look at, and I like to compare this fund to NEOS, which is Spyi, and I like to compare this fund to Xdte. NEOS, the reason why I'm comparing it to NEOS is because NEOS also has this kind of model where they try to have some tax efficiency, some growth, and some dividend. It's kind of like middle of the line. And NEOS offers, they don't do 0 day to expiration from what I understand, but they offer a 12% yield dividend distribution plus whatever growth they could get. They target 12%, 1% per month. So you could see in the same exact time frame of 80 calendar days, NEOS did not perform as well, because remember, NEOS, you can see here on the blue, 3.58%. So NEOS total return lagged the total return of the SPX, because again, SPX, which is the index, is 3.17. Maybe I'm wrong. 3.17, and NEOS 3.58. No, I am wrong. So NEOS actually outperformed the underlier index by a little bit in the same time frame, but TAP Alpha Tspy did even better than NEOS. So both of them are outperforming in total returns if you include the growth plus dividends, but Tspy did better. Now let's look at Xdte, which is a Roundhill product. And the reason why I compare it to Xdte is because Xdte also does 0 days to expiration, a little different. They do overnight exposure, so that could be a plus or a minus. And they also pay out more in distributions to the shareholders of what they make versus Tspy. So on the front end, it seems like, and you have more choice what you want to do with the dividends. But look at this, Xdte, the same time frame from August 15th till today, 4.3%. Outperformed NEOS, outperformed the actual index. And then Tspy, 4.35. 5 basis points beat Xdte. Past performance is not indicative of future gains, but they're very close. They're very, very, very close. 2 0 day to expiration strategies, one with overnight exposure, one not with overnight exposure, and Tspy actually owns and holds the actual underlier. I don't think that Roundhill may or may not do that, but it's very interesting. And they talk, and then the guy has a proprietary software. So there's some pluses and minuses. So he is, by trade, he is a software engineer, and I'll save you a couple hours of videos. Here are my cliff notes right here. So he basically has an expense ratio of 0.68%, which is better than the Roundhill expense ratio, but it happens to be the exact expense ratio as Neos. And he talks about his mechanics. So he looks for a 0.25 delta or lower when he writes the calls. So he gives you a chance to capture some of the upside. A 0.25 delta is an option term, which means that about 25% of the time, it'll be a loss, because that means that the price will go above that strike price, and 75% of the time it would be a win. So you put the odds in your favor every single day. And they have a zero point 0.4 to, he talked about in his videos, he says typically the proprietary software chooses about, and if you look at the 0.25 delta, a 0.4% to a 0.5% out of the money. So every single day in a typical day, they're able to capture some growth of the underlier of the S&P 500, about a 0.5%. And it's sometimes when there's like Jerome Powell's giving his, there's a binary event happening where there could be some more volatility. They may want to have a little more safety. Remember, it's a 0.25 delta or lower. So sometimes they'll even give more breathing room of even 1.5%. Out of the money. So that means you can capture in any given trading day even up to 1.5% in certain trading days. That's what the fund manager said. This is my understanding of what the fund manager. Look at all the videos. I'll send you the link so you can see it. Again, he uses a proprietary software from fintech. He talked about that in about October 2022 is kind of when he started getting into the options. That's what I understand from the interview. So he's kind of newer. He's not like a veteran in option trading fund manager for 20, 30 plus years, like other option, fund managers. He seems like a guy who comes from a different space that came into this. So there's some pluses and minuses. It may be a good thing, it may be a bad thing. It depends on your style. Again, there's no overnight exposure, which we mentioned, and that could be a good thing or a bad thing. There's something called gap up in the market, and that's pretty cool. And then the Roundhill, you get that gap up in the market. There's a whole study on how sometimes it can be very beneficial to have that gap up, but you can also have a gap down. So, so maybe, I'm thinking, if I would have, hypothetically, this is just my own thoughts, if I were to have like a little bit of both funds, I would get the benefit, I would have like kind of a diversified risk. I would have a gap up exposure and a non-gap up exposure fund. That's just something that I'm thinking about personally. I'm not telling you to do, I'm not a financial advisor. He talks about using SPX, which has, speak to a tax advisor. There's something called 60/40 tax rules that it's a blended tax rate, between long-term and short-term capital gains. Again, go talk to your tax advisor, do some research on this. Don't take it at face value from me because I'm not a tax professional. So the first payment came out, and let's talk about details. They only had one payment to date that we can go off, and it was October 3rd. And the fund has been open since August 15th. So, and the amount of payment was 29 cents. There's more, a little bit more decimals and stuff after it, but about 29 cents and change. That was the first payment, which he says actually came out to be a 14.2% yield. So he did mention in the interview what is his income target yield, because he's looking for income and growth. And the way the fund manager describes this fund, he says he describes the fund as a mild to moderate risk fund relative. I would imagine when he says that he means relative to the index, because there's always risk of the index going up and down, but relative to the index, it's a mild to moderate risk fund. Because again, he's putting the odds in your favor. He's putting a 0.25 delta or less. And he says his target is 12 to 14%. That's his target. So that's why I said I like to compare it also to Neos, because they share the same cost basis and they share the same target. Because Neos target, if you go on their website, and I'll pull it up for you right now, you'll see that on their S&P 500 product, this is the wrong one. Here it is. On the Spyi product, they do talk about that they target about 12%, 12.11%. They do target. That's why I'm kind of comparing it a little bit to Neos and also comparing it to Xdte. So he said this just to put things into perspective. The reason why that first payment, well, of course, My theory is a lot of times fund managers like to give the first payment. This is just my own personal theory. Fund, it's beneficial for fund managers to give a juicy payment in the beginning, kind of like an entry thing to get your appetite salivated, to get more people to buy into the fund. So they try to boost it as much as they can initially. That's just my own. I'm not saying there's any foul play, but I think, I don't know, whatever. That's just my conspiracy theory. But he did mention, he was very transparent. He mentioned that the 14.2% yield, that he mentioned does include a dividend because they own the underlying, not Spy, but SPX. It includes the SPX dividend that's built in there. And he mentioned that some of the growth, some of the upside that the SPX achieved, 20% of it was paid out in this dividend, and he let 80% grow. So that dividend includes three components from what I understand listening to him talk. It includes the option premium, it includes the dividend that the actual underlier produced, and it also includes 20% of the growth that the underlier grew from market growth. So if it wouldn't have been a period of time where the market would have grown, it would not be built into that. So it's three factors that's comprising this dividend. If you want to look again, let's take another look at the market growth. You'll see if you go to SPX, you'll see that SPX grew, if he says on the orange, it grew 3.17% actually in price. Total return 3.17. But if you go to the Tspy, you could see that, oh wow, it grew even, it grew almost as much, the 3.14. So I also wonder why Seeking Alpha, if SPX gave a dividend, I don't know why Seeking Alpha didn't factor that in the total return. Because there should be a little bit of a different discrepancy if there's a total dividend. Anyways, let me get back to the on track. So again, he mentioned that he is a computer software engineer. He's looking to also, he mentioned he may want to license out his trading software, fintech, to other companies fund managers who want to use it. That saves a lot of time and efficiency. Again, could the software glitch? I don't know. I'm not a software guy. Is it good? Is it bad? Sometimes software AIs can help make things more efficient, can take away biases and sentiments. Sometimes it can help streamline things and keep things more mechanical. So I could see a lot of appeal in efficiency and optimization. And sometimes there could be some downsides if it doesn't work, if it doesn't work well, if it has to be troubleshooted. Again, one of the strengths are he is a computer software guy. So, he probably knows about this a gazillion times more than I do. But, take it as what it is. We mentioned the moderate risk. We mentioned all this. So here's a couple of videos I'll share with you in my link. I'll put in the link in my description. So like I said, when it comes to income growth standpoint, getting getting 14% doesn't seem very, very sexy and appealing. For relative to other growth income products out there. But the reason why I'm attracted to looking into this further is because of the total return. The total return has beat just by a hair the Xdte, which so far has beat almost everything else that I've seen so far. Based on the same underlying index. And it has a little bit of a different strategy, doesn't have overnight exposure. It's just something interesting, a little wrinkle. I don't know if this will be a massive holding in my portfolio if I were to look into it, maybe because in order to get meaningful income, I would have to have like a lot, to get like $1,000, I'll need like $80,000 plus to invest, achieve $1,000 a month in this with this fund. So, maybe if for those possibly looking for something that fights against NAV decay, but again, like it would have market risk. But I'm talking about NAV decay, price depreciation relative to the market price. So, so there is a use case for it. I'm gonna keep a close eye on it. For now, I possibly we'll get into it here and there. I'm thinking about it. It's a contender. I'm not saying for sure, but it's something that I'm looking into, and I feel like I'll share my research with my viewers. Anyways, this is the Working Investor over and out. I hope you guys have a wonderful and fantastic weekend. All the best.